Hi, good evening, everybody. I'm Rauf Said from Noble Sky International. Um, Hope everyone is having a great start to the week. I know it's a Monday, and most of us will probably be working from home. Some of you might be going out to work, and we had not too bad a start for myself, especially. So we had some things in order, creating new systems, and hoping to meet new potentials who's looking at working with us and investing in the US. So as of now, what we have done is to just stream this particular video to our group and to our group alone. So we are only streaming to the group here in US Real Estate Investment Success. I think that's the name of the name of the group. I apologize. Yeah, US Real Estate Investing Success with Noble Sky. So the reason being, we want to be able to allow more people to come into the group, and as we grow this community, certain content will just be shared freely in this particular group itself. Okay, so I hope that everyone is doing well, and still staying safe in spite of. I know there's when I went out, especially to the mall or out to the beach, there's a lot of people all out and about, and sometimes we tend to lax. We tend to get a bit complacent with whatever's happening around us, and we tend to not ignore safety, social distancing measures, and just be very casual with everyone, and that can actually spell a risk for ourselves down the road in case there's a cluster of infections that we have no idea can happen to us, right? So that's all I want to say. Still stay safe regardless of what the measures are, as much as possible. Wear a mask, and whenever you're out, just make sure that you have a sanitizer with you or your mask with you, and keep your social distancing as far apart as possible. Okay, so without further ado, let me just speak about what we want to talk about today. So specifically for all those of you who's watching this particular video, you're from this group, and I've met a lot of my investors. And a lot of my investors, whenever I speak with them, there's always a conversation whereby we need to come on the same page. And if you don't come to the same page with your people that you're working with, especially in the world of investment, things can get very, very dicey down the road. Why? Especially when it comes to money and returns. What I'm talking about specifically is investment returns. If you're working for someone, and if you're putting your money, because it's very personal, it's something very highly personal, it's money hard earned, and then you decide to invest that money into a product, into an investment vehicle or whatsoever, right? And you expect a certain kind of returns. And that's why in the world of investments, if you want to be able to have access to things that is only available to private investor or those with accredited investor, meaning that you must be able to invest at least, or you must be someone who, what the government call an accredited investor, someone who earns in Singapore is about 250,000 Singapore dollars a year, as well as or a net worth of 2 million Singapore dollars in net worth, excluding home, your personal home. Okay, so if you want access to all to different kind of investment that you normally might not get in public, then you must belong to this group of accredited investor. And why the government only allow access to this group of accredited investors is because they feel only accredited investors are able to have the mindset of expecting the correct amount of return, which is somehow quite true, because when you speak to them, and you speak to a regular layman who's starting investment for the very first time, you would realize that the one who's starting investment for the very first time is always expecting a very high quantum of returns. Well, not all across the board. Sometimes there are exceptions, but usually it is the case. Why? Because when you look at investing your money, you're looking at anything that can make you the highest number of returns as much as possible. So I was involved with entrepreneurs before in Malaysia, in Singapore, and I spoke to a lot of them, whereby a lot of them have the mindset of, I want to be able to put my money into something that I can generate multiple return, 200, 300, 400% as much as possible. Well, they're actually talking about their own business. whereby a lot of them take like $500 and then they pump their money into an online e-commerce or an online, because they're selling products, they decide to go put it into marketing, online marketing, digital advertising on Facebook, on Instagram, and they start selling their products, and then they're getting that kind of returns. Okay, they're getting like, whoa, 300% return because they're able to transform a $500 investment in Facebook ads and able to generate that kind of returns in like 2-3 months, and they get excited, right? Well, that's amazing. Okay, if that's something that you're able to pull off for yourself, then by all means keep on doing that. However, in economic terms, there's also the law of diminishing returns. Keep on doing that. At some point in time, you will realize that people will respond lesser to your ads, and you will see your returns diminishing down the road. And at the same time, that's not an investment. Okay, I know you call it investing into your own business, but technically it is not. Now, what I'm going to talk about now, let me just bring it up. Okay, what I'm going to talk about specifically right now is investment in terms of you taking your funds or available capital that you have, spare capacity. You take those funds and you put it into a vehicle, into an investment product, and you step off and you let it grow on its own. Okay, what are some investment products that you have? There's plenty. Okay, that you can think of. Like example, fixed deposit. You just leave your money there in the bank, and the bank will give you returns, right? Every year they give you return 1-2%, paltry returns. Okay, or you put it into an index fund. Hopefully it goes up. Hopefully it doesn't go down. You keep going up, and then you earn maybe on average per year it goes up 5, 6, 7%. Or maybe you put it into investment link fund with your insurance agent. Right? Insurance agent who will help you plan your investment. There might be investment link plan. And what else are there? There's plenty, right? Of all these passive kind of investment. Yeah, those are what I'm referring to. Now, for the more advanced investor, then you might be looking at investing in something like you do options, you do stocks, or you do things like forex, whereby you invest your funds to forex and you know exactly when it will go up and you will increase in value, and then you exit at the right time. Those, you can call it those investment, but although it does require a bit of your time, a bit more. And then there are some of you who dabble in the world of crypto. The crypto investing would be something highly dangerous if you have no idea how to do it, because you might lose your money. Same with crypto, or same with forex or futures. It's highly dangerous if you have no idea, how highly risky. You have no idea what to do, what to see, the chart, how to read them. Don't dabble in them. Okay, those are highly risky. Then there's some of you as well who will probably look for businesses, right? You look for a business that is able to give you returns as a shareholder. There are, and I spoke to a lot. I met a lot, hundreds of you down the road, for the past few years, and hundreds of you have told me what kind of investment that you've been involved in. And there are some of you who invest with other friends who set up their own business. You're a shareholder in a business that you're not involved in the daily operations. Now, that's an investment. That is an investment. Why? Because you are not literally going into the business, working in the business, like selling the product, sewing your clothes, or going online. You're not doing that. You are just giving money to the director or whoever's running the company, and then you're stepping off, and then you're earning dividend as a shareholder. That's a passive investment. That's what I'm referring to. I'm not referring to when you take the fund, when you have your own business and then you pump your money inside there, okay, and then you just keep on growing your business. It's like a job. It's growing your own business. It requires your time and energy. If it requires your time and energy, I'm not referring to that. Now, when those of you who has access to this type of investment, people who speak to you about being a shareholder in a business, those can potentially give you great returns. Okay. Now, the thing I want to talk about, how many percent returns, how much returns is considered good? How much returns is sufficient for you? Now, this is the tricky question that you are going to be constantly faced with. Okay, I'm just going to draw a couple of things here. Okay, there are a couple of investment products, like investments such as, okay, you can see this. All right, you have things like fixed deposit. Then you have bonds in the bank, and you have things like stocks, unit trusts, then something such as maybe forex, when you have futures, options. Another one A lot of your favorite real estate. And you have things like maybe what you call other business. Okay, there are people who invest like that, right? So these are just some of the available investment options that is potentially something you can get involved in. Okay, it doesn't require you to spend too much of your time to generate the returns. If you have to be in the business to run and sell a product, deliver to the customer, do transportation. Now that's like a job. Don't that's not what I'm referring to right now. I'm referring to something you can just put your money there and then let it grow, and then you receive some form of dividend or distributions every year. Okay. Now this is some of it that is potentially available for you. Okay. Now I am asking you right now, how much is enough? Okay. How much is enough for you? How much returns is sufficient for you to say, okay, I'm happy. I'm happy to earn 20%. I'm not happy if I get 15. Okay. Now at that point in time, this is where you have to ask yourself this question. If you want to base your returns, if you tell someone, look, okay, I have this case whereby every time a new investor come on board with us, okay, they are always telling me, I want 100% returns. I don't care. You give me 100% returns or 200% or 500%. I want that minimum. Okay, then I will like, wow, you're asking for a lot. That's a lot of returns you're expecting at this point in time, especially when I'm not too sure exactly why are you basing your minimum returns amount based on like a few 100%. Well, because who doesn't want more? Okay, of course, if that is your answer, then I can also say the same thing. Everybody wants more. Everybody wants 200%. Even heck, I want 500% minimum, 1,000, 20. There's no, it's infinity, right? There's no low number. It's everyone wants as high as possible. Then how much risk are you willing to risk? Zero risk. I don't want to risk anything. Okay, there are ridiculous kind of demands from people. I want zero risk and as high as possible. What exactly? What kind of investment is that, whereby it's allowing you to be able to earn a few 100% with zero risk? Tell me that type of investment, and I will invest as much as possible, probably a few $100,000 with you as soon as possible. Okay, you cannot find that kind of investment out there. There are none. There are none that allows you to just enjoy as high return as possible and with zero risk. There are none, totally none. So your question now, if you put such a high figure for yourself upfront and expecting the fund manager or whoever investment manager to deliver that to you, otherwise you're going to be very upset, then you are putting yourself in a position whereby you're always going to be upset. Okay, you're always going to be upset. You're going to be disappointed at all times. Why? Because there are very, very few returns and very few investment out there without the risk involved for you to be able to do that. One story I want to share with you. There was a class that I had. Whenever I do my class, I will always ask them, what are your current returns that you're earning? Okay, I will always ask them this. Then they will always tell me, okay, they have some of them 10%, 50%, some of them as high as 30% a month. 30% a month, it's like almost 360% a year, and not even compound returns are excluded. 360% a year, and he's telling me it's very safe. Well, that is where you have to really stand back and analyze exactly, is he saying something that is legit, or is he saying a bunch of baloney? Okay, in my opinion, it's a bunch of baloney. Okay, why? Let me explain. Okay, how much return is enough? How much exactly is enough? What is enough for you? Where in the returns bracket would it be sufficient for you to say, okay, I'm happy. I like this number, okay, every year, and I'm going to invest more. Why? Because I like it. It's sufficient. Okay. Now, firstly, you got to ask yourself, what are your current investment performing? That's number one. What are my current investment performing annually? Okay. What is it? What's the number? What's the number? Is it 5%? Is it 10%? Is it 20%? Okay, you have to ask yourself that question annually. Now, if you have things like you invest in the stock market, do a simple analysis. Okay, if you invest $1,000 and then you get back $1,100 by the end of the year, you're earning 10%. If you invest $1,000 and then you get back $2,000, you're earning 100%, right? Because you double your money, it's 100% returns. Ask yourself, what are your current investments earning? If you don't have anything, okay, if there's nothing at all, if nothing, no investment background before, then your number can be a safe 1.5 to 2% based on bank deposit. Depends on your country. Okay, if you're in a country like Malaysia or Indonesia or India, then your returns is 7% probably. Okay, but then you're based on 7%, 6% based on the local currency, not US dollar. Okay, so now if you are from Singapore and your returns is about, if you don't have any background in investment before, then you can safely say 1.5 is actually your number. That's your bare minimum. Okay, your bare minimum is that 1.5%. Then, but I don't like 1.5. I want 15% at least. But you're not getting 15% on your own, because right now the question is, what are my current investment performing annually? If you don't have nothing on your own, then you're just a paltry 1.5 to 2%. And that is the amount that you should have a reference from. Your point of reference is 1.5 to 2%. You want to take 2%? By all means, okay? 2% would be your reference point. Okay, that's your minimum. And then ask yourself, if 2% is my number, and if a new investment gives 20%, right? Technically, you have just, what happened? 10x your returns. Okay, you just 10x. 10x is 1,000%. All right, what 10x means 1,000%. You just 10x your returns from your current 2% by getting an investment give you to 20%. All right, you just 10x your returns. Then if you have an investment that you look, wow, I'm getting 20%. The example you put, if you put the $1,000, okay, 20% would be, return would be $1,200. Okay, correct. Now if it is 2%, it is $1,020. Okay, it is $1,020. Correct? Am I saying correctly? Yeah, correct. All right, $1,020 and $1,200. Yeah, that's the number. This is at base of 1,000. If you invest 1,000 and then you come back and say, but $1,200, $200 is so little. I want to be able to invest more and invest 1,000 and get $5,000. Okay, I want to get $5,000. Can I get $5,000? Well, technically you can, but then what is the investment exactly that you're involved in, and what kind of risk are you being associated with when you invest in something that's being promised to give you 5,000%? Well, I'm talking ridiculous now. I'm being ridiculous, obviously, but the point is this: if you are able to get, okay, $1,000, if you're able to get $200 from a $1,000 investment, 20%, is it good or is it bad? What do you all think? Drop me a text. Is it a good returns or is it a bad returns? What do you all think? Just a few of you watching now, right? Is it a good return or is it a bad return? The answer is a simple yes. It is a great return. Why? Because you have just 10x your returns. From 2%, now you're getting 20%, which is 10x. And that's actually a returns that you should be very, very, very happy with. Okay, you should be very happy with those kind of returns. Now, if you're investing $1,000, getting 20%, yes. But then again, tell yourself this: investing 1,000, getting 200 after 1 year will not make you rich. If you want to be able to become rich, you need to run another business. Okay, and investment might not be for you, especially if you're just inventing to invest $1,000. Okay, if you just wanting to invest $1,000, then it might not be for you. Unless, of course, you have several businesses running, you have a second job that you don't have the time, but you have some spare cash sitting at one side that you don't wish to have it in the bank and do nothing and earning 2%. You want to have that money be able to perform in a much better investment vehicle, such as maybe you invest in your friend who does forex, or you can invest in real estate. Either one. Okay. Now the point is this: if you receive back your money, okay, if you receive back your fund, because the question today, how much will you be happy with, right? If you receive back at $200, $1,200, and then comparing it by yourself. The answer is this. You have to always compare what are your current investments performing annually. That must be your first question. By myself, how much am I getting? If I were to do with someone else, then I must get a higher rate because he's a professional. Okay, does it make sense? It should make sense for a lot of you. If you're working with someone, okay, then he should be able to return you more, because by yourself you're getting 2%. You're not going to say, okay, if I work with you, I'm also going to get 2%. Then that doesn't make sense. Okay, all right. So it is important that you know your point of reference. Your point of reference is this 2% if you're doing by yourself. Now, if you are someone who is currently, example, okay, your current investment is earning you, your current investment is earning you 15%, okay, then your new investment must exceed 15%. Make sense? All right, your new investment must exceed 15%. Why? Because a minimum number that I feel should be more is that you should look at your current number. It should be at least 30% more, 30 to 40% more than what you have currently on by yourself. If 15%, an extra 30 or extra 40% on 15%, it is about extra 6. So you're looking at about 20%, 21% minimum returns. So your new investment is increased by 40%. Okay, increased by 40%. Your new investment must earn you at least 21%. Okay, no, but not okay. Now this is going to get confusing. Sorry, before you think it's funny. So you want to increase by 40% on 15% means you're going to increase by additional 6%. So your new investment must earn you at least 21. Okay, does it make sense? Okay, so that is the current number, at least 30 to 40% more. Why? Why should it earn you more? Well, because you have a point of reference. Your current point of reference is 15. Your new investment should be able to deliver you a higher returns based on what you are able to perform by yourself. If you're not able to perform a good returns, then if it's 20% returns from your new investment, then you're doing very, very well, right? Because if it's not able to earn you at least 21%, if you're not able to earn you 21%, then your current investment is it's not exactly the best, right? Because your new investment earning you less than 15%, so it means obviously that you're not performing. Okay, that investment not performing, so you should look at something else. That's what I'm saying. Sorry, I know I mixed up my words, because current investment, new investment. Okay, so my point is this. Okay, if you're looking at something new, there's something new that you're looking at, always ask yourself, what are your current investment earning you? Your current investment must be you must have a number to your current investment. It must give you an annual number. Okay, that's sufficient. If your current investment is not even 15, if your current investment is 30% per year, then you must find something that can beat 30%. That's my point. Okay, you must find something that can beat 30%. If there's nothing else that can beat 30%, then you probably should stick with what you're investing currently. Unless, of course, if you are doing something 30%, but at the same time, very risky. Correct? It is very, very risky. If it's very risky, then you don't mind investing in something a lot more. Lower your risk. Lower risk. Okay, you don't mind investing in something lower risk. May probably earn you 20% to 25%. Even though your current is giving you 30, but because you invest in it, you're not able to sleep at night very well, just because it is so volatile. There's a lot of volatility in the markets, and you have no idea what your investment are doing. You have no idea whether is it going to go up, or is it going to crash anytime soon, and you might just lose everything. Okay, so those are some of the questions that you might need to ask yourself. If it's so risky, then you might need to diversify away your risk into something different. Okay, into something else that can lower your risk and allow you to sleep at night better. Okay, all right. So some people will say this. Okay, I want to be able to earn as much as I can, and with as little risk as you can. So you have to have like a standard. I always cover this during my class. A standard. Okay, a higher returns. Okay, in the category of returns, right? Okay, in the category of returns, what is considered as high High is anything 10% or more. Okay. Then there's medium returns, which is between 5 to 10%, and low returns, which is less than 5%. Now, this is under the returns category. Okay. If you are investing in something, in whatever that you're doing, and then it is delivering you more than 10%, congratulations, you are in the what we call the category of high returns. Now, this is the world of investment. We have to standardize it, right? If there's a standard, there's a point of standard for everyone to refer to, and you are receiving this. Okay, my fixed deposit giving me 2% is low, but it's very safe. Okay. But then if I invest something else, it's able to give me 12% return. My unit trust, for example, my unit trust giving me 12% returns. Give yourself a pat on the back and clap hand, right? Because your investment is performing in a high returns category when you standardize it with the rest of the world. All right. So then there's also this thing called returns, and then which is the exit period. Okay, which is okay. I won't call exit. I call it duration. Okay, duration, long term, mid-term, short. Okay, long term, mid-term, and short. So what is long term, mid-term, and short? Okay, long term, mid-term, and short will be things. Long term is anything more than 10 years or more. Okay, mid-term is between 5 to 10 years. And short term is anything less than 5 years. Okay, so this is considered short term. Now, if you are investing in an investment like unit trust, usually if you want to be able to earn 10% or more a year, then you're looking in a long term. Okay, now this is the part where everyone always asks. If I were to ask you, Mr. So and so, if you are able to invest, if you can choose, of course, everyone will not have the right, will not have the liberty to choose, right? But let's say, for the fun of it, you are able to choose. Where would you want your returns to fall? Where would you want your investment to fall under? Everybody wants their money to fall in the high returns category, and short, long, mid, or short. Short. In other words, I want to earn as much as possible in as fast as possible, which is what everybody wants. You want a short-term investment that can deliver you 30, 50, or 100%, right? Well, that's the thing. It is very tough to find investment vehicles like this, whereby it's high returns and considered short-term. It is very, very, very difficult. In fact, I dare to say US real estate with Blue Sky is one of the few investment vehicles that allow you to earn high returns in a short duration. Okay. Now, if you are able to find, then my question is this. You have to ask another 3 more questions when it comes to this. Okay. Number one, in terms of risk. Okay. What kind of risk are you going to be involved in? Is it high risk? Okay, high risk, low risk, medium risk? It's a question that you need to know, right? You need to know what kind of risk are you going to be exposed to. Okay, so if you're going to be exposed to a high investment return in the short term, likely it is also considered high risk. Okay, are you willing to invest in that investment by exposing your money to a high risk product? Are you willing to do that? The next question, if let's say you're willing to, okay, and then the other thing to ask is how much capital are you exposed to? Okay, capital exposure. Okay, you have to ask yourself this question. A lot of people come back to me, okay, and I ask them. There was a class student who said, like I told you earlier, he's making 30% a month, 30%, and 30% a month. Wow, 30% a month. And I asked him, is it risky? He said no. And it's a month. You can exit every month. Yeah, you can exit every month. Is it risky? No. So then I asked him the next thing. So if it's only 30% a month, it's extremely high, extremely good, and you are not exposed to any risk, how much are you investing? And he said, I just put 10,000 maximum. Okay. Why do you put 500,000? That was what I asked him. Why don't you sell your house, sell everything that you have, put the money into this investment because it's obviously generating you plenty of money. 30% of money is safe. Why don't you do that? Then his next answer was something that backfired. Oh, because I don't put all my eggs into one basket. That was his answer to me. Now I was like, it was in class in front of everyone, and I know if at the next question I ask, it might embarrass him. So I said, so why not? Why not? Then he realized he just shot himself in the foot because he told me earlier it's not risky, but he's not putting all his eggs into one basket. So obviously it's a bunch of baloney. Okay, and then when I inspect and ask a few questions, I know there's a scam. It's a forex scam. Okay, that he's involved in. All right, but because he's earning money at that point in time, he's earning returns every month. So of course, to him at that point is not risky because he's earning the money. But to someone new, especially the scam that's about to crash in the next 3, or you see it's been around for 2-3 years, it will crash anytime. So those are the kind of people who say this is very risky. Those people who's about to get into that kind of investment then will say this is highly risky because if it collapses, I will lose everything. Okay, so I asked him then, why not? Why don't you just invest everything there? His answer was, I don't put all my money in one basket. Why not? Then the next question that he was jammed. He didn't know how to answer. So I stopped and then I just divert and talk about something else because I know the next thing I ask, he will just embarrass him in front of everyone. I don't want to embarrass him. Okay, so capital exposure. You might be able to invest in something like, for example, you put in things like 10,000. Okay, might be something low risk to someone who has a couple of $1 million to throw. But for someone who is investing his hard-earned money, he has saved his money for 10 years, 1 year 1,000, he saved 10 years worth of savings. This 10,000 will not be something he's willing to just throw into any Tom, Dick, and Harry investment. He will not be willing to do that because his exposure is too high, his risk, his tolerance is getting very, very low. Naturally, if you have low risk tolerance, whatever you're exposed to, you want it to be very, very, very safe, in a very safe investment, correct? Okay, because it's just too high capital exposure. Third question, okay, is this. If you're able to do this, something low risk, high returns, short term, you can invest as much as you want, okay, then the next part will be this. Is it repeatable? Is it repeatable? This is another good question for you to ask yourself this whenever you want to invest. Is it repeatable? If I can get that, some people tell me that I can get 200%, okay, 100% returns on your investment, 100%, 200%. Because in my class, what we always do is this. I always ask the class, okay, tell me now, what are your current returns? What is it that you're investing in, and what are your current returns? This is especially prevalent in my class in Cambodia. In Cambodia, everyone, especially in the class, I ask them, what are your current investment and how much is it earning you right now? So in the whole class, everybody write down the number and what exactly is that. They told me, half the class were telling me land. Everyone put land. Like 3-4 years ago, they had their one exit, that one exit that give them 100%, 200% returns, and they put it as a case study for them in class to tell me that's my current reference. My reference point is at 200%. It's not. Because that was 2-3 years ago, and you're not even doing that consistently, right? So I said, okay, so you need 200%. Wow, amazing numbers, great, 200%. What is it? Land. They flipped the land. There was a Chinese developer obviously from China, who came in, bought the entire land, all the land, all right, because they were developing some kind of resort or condo, I have no idea. And they made like instant cash. Somebody they did not even, it's not a case of okay, I'm doing this analysis, I'm studying the area, I know this place have a lot of potential, so I buy the land now. No, most of them were inherited or they were just previous landowners, right? They were just landowners, so they're just lucky enough to be at the receiving end, whereby the Chinese developer and the Cambodian government decided to have an arrangement, and then they bought the land off from the previous owner. Okay, and they made 200 to 300% returns. 1 to 2, it's a lot of money they made, a lot. And they told me, yeah, okay, that's my current number now. So anything I want to invest, especially with Noble Sky, with real estate, I want minimum 100%, 200%. Then I inspect further and further. I ask them, okay, wow, amazing numbers. So, are you still buying the land? I asked that question. Are you still buying land? Oh, no, I'm no longer buying land. Okay, so it's not repeatable. You cannot repeat it. Why do you buy land now? I said, why do you buy another piece of land right now? And repeat the returns. Oh, no more land. Now land too expensive. It's too expensive. They cannot repeat it. You're not able to replicate what you did before. Okay, and that is not a fair number to base on. That is luck. Luck for you is you just had the luck then to be able to cash out from some because your government decided to sell the land to the Chinese developer, and you just were at the receiving end of all this. the windfall, right? You had a windfall and you made the money. So then you cannot use that as a point of reference. That is not your point of reference. That's just pure luck, okay, on your end. On your side, just pure luck. If I ask you now to find another land and repeat that process to make 200%, you say, oh, very difficult. It's going to be very tough to find another land now because everything's a lot more expensive. I don't know whether any developer wants to pay for so much premium on the land that I buy now. It's going to be tough. Okay, so this is something that you have to consider. If you have this kind of like someone that you want to consider, or an expert, that they might ask you this kind of question. They might ask you, okay, so are you able to perform this by yourself? Like if you work with Noble Sky, I will ask you this question. Same thing. Okay, if you have put a minimum number of 15%, I want 15%, then I will tell you probably we can work with you, because the returns that we always frame our investor to expect is about between 10 to 30%. Depends. If one's flip or rental is different kind of expectation. But if you come to us and say, I want 300%, then I will sit down with you. I'll probably do this exercise and go through with you and find out, well, okay, if you're expecting 300%, why? Why are you putting so high a number? Or why? Because I just want more. That's not a fair number, because if you still put that and then expect us to be working together, I don't think we can work together. Why? Because the number will not be suitable for us. I will not be able to meet your demands. It's too high a number. Okay, so we have to come to a point whereby we have to agree, okay, to disagree, and then maybe you find something else and not do real estate in the US. On our side, our minimum number is for flip that we always target. Our minimum, I think my screen hang. I apologize. Okay, sorry. All right. Our minimum number that we always target for our investor, for when it comes to flip, is at least 25% to 30% or more. And when it comes to rental, on the net rental yield, is at least 10% or more. Okay, sometimes you drop to 9.8, it might drop. Okay, but that's just us being very conservative. So if this is something that you feel, okay, hey, I think I don't mind looking at those kind of returns number, because those are fair, and that's not something over the top, and that's not too low either. Okay, so if this is something that you feel, okay, I don't mind looking at something that is between 10 to 25%, 30%, then you just want to find out more whether should I do flip or should I do rent. Okay, it has different psyche of the investor, will probably be suited to a different type of investment model. Either you do flip or you do rent. Next, another one that we do is called short-term rental, which is dealing with Airbnb. So it's quite fun actually. Okay. So, well, I think I've overstayed my life, which is right now is 10:08 p.m. Okay. Thank you so much for tuning in. I hope that you learned and take away something from the lesson, the session earlier. This is just me letting people know that, hey, sometimes putting such a high figure without a reference point is not something very fair. Okay, you have to be realistic. All right, and if you're able to earn 15%, but if you previously do on your own 1%, then it's actually a good investment amount. It's a good returns for yourself. Okay, don't be upset. Don't be sad that, oh, I want to earn 3 times, 4 times. That's not for you. You probably might need to find a business instead. Okay, to deal in business, an actual business that you're going to run by yourself. Then you probably can earn that kind of returns. Otherwise, if it's a regular investment, then I would suggest that you look at something else. Okay, all right. So that's about all that I have for this evening. I hope you have a great week ahead. And if you have any further questions, you can just drop a comment here into the comment below, and I would love to answer them. Okay. All right. Thank you so much for watching this, and I wish you all a pleasant night and a great week. Bye bye.